Gentlemen, are you a long-suffering Manulife REIT shareholder? Are you a long-suffering Prime REIT Life shareholder? Essentially, both of these REITs that fall within the US office REITs that are supposedly touted as value buys by analysts, the media. Have they actually turned out to be the kind of investments you're looking for in real estate investment trusts? In this week's video, we're going to explore into this, whether these stocks have actually fallen or are classified now as value traps, as opposed to value buys. As usual, in real estate investment trusts, whether you make money or lose money depends on who you listen to, depends on basically the kind of REITs that you should have in your portfolio. So without further ado, let's delve into it. And as usual, if you like what you see, do subscribe and become our subscriber. Send us an email at gcpglobalsg@gmail.com so we stand to win a chance to actually win a prize just by recommending a friend to be one of our subscribers. In this month's publication at GCP Global website, GCP Global, to go to our website, we actually questioned and bring forward to your kind attention whether US office REITs listed in Singapore, the first of which was listed already in Singapore 6 years ago, that's Manulife REIT, are actually value traps. So what are we going to question today? Are they essentially evolving or have evolved to become value traps? Two, will they continue to trade at low multiples, in terms of DPU yield and book values? And gentlemen, what are value traps, you may ask, as well as the fact that how do you know before these REITs became value traps that you should not be investing in them? Because remember, money invested in them will be opportunity costs. And secondly, you will even suffer tremendous losses for some of those. Let's explore further. First and foremost, what is a value trap? The value trap, as the name suggests, ladies and gentlemen, are stocks that are, or REITs, that apparently present good value. For example, the US office REITs like your Capital Old, your Prime, and your Manulife appears to be hitting DPU yield of 10%. Now, I always use the word appears because over the years, if you actually track them closely, what they say, what analysts actually project the yield to be, eventually, do the DPU come in close to essentially meeting the forecast? Because failing which, you will see that the earlier forecast probably is too bullish. So because one of the consequence of being a value trap is that these companies continue to disappoint in terms of earnings delivery and DPU delivery again and again. And that's why they are actually traded at such high multiples. Because if the market is efficient, of course, and generally is populated by the intelligent hedge funds, the intelligent family offices, as well as high net worth individuals. So if something is trading close to 10%, without any particular flaws, why not actually just put all your money in this? Because in 7.5 years' time, you will double your money without even battling an eyelid. But what is the problem with the US office REITs? Much as what the media, the exchange, as well as actually the analyst is actually touting. Okay, so let's look at our article as what we have in our article that we have addressed or highlighted is that our US office REITs underperformed for such a long time that they are already value traps, or are they already value traps? And have US office REITs actually overpromised but actually underdelivered? That's why they actually fell into a value trap. So what is a value trap is something that we cover in our article. Do read them, come to our GCP Global website. We have a wealth of information from our 33 years of education and of in-depth analysis into real estate investment trusts, as well as other award-winning equities and bonds. Okay, what is the danger of a value trap, ladies and gentlemen? Now, the danger of a value trap, as we have defined, is that the clear and present danger is that they present itself, when a REIT or a stock continue to languish or drop further, even though after you have bought into them, when investors buys into the REIT or the stock, that is, they continue to drop further. Now, is that the case for all these three office REITs? Like Manulife REIT, if you look at essentially the latest month ended in May versus the prices in 2019, that means just before COVID-19, right? You will see that essentially Manulife has dropped by 40 cents or a whopping loss of 40%. Yes, a capital loss of 40% compared to the prices as of end of 2019. For Prime, is not even better. I think you would be saving more money if you spend money eating on Prime REITs as opposed stakes rather than putting into Prime REIT, because Prime REIT actually fell 25 cents or a total loss of 26% compared to the prices at end 2019. What about for Capital Pacific Old? Not so bad, it's only down 10%, but nonetheless, it's still a loss. Now, at GCP Global Classes, you notice that we always highlight, and we have been highlighting for all our student investors, which total 8,000 student investors right now, after 33 years of teaching, how were we able to decipher and pick for them in our investment classes, our REIT investment classes, to stay away from these three REITs for the longest period of time, okay, which is something that we will share with you in our classes, as well as actually in our write-ups. Prime REIT actually listed in 19th of July 2019 at 88 cents. So for a very brief period, that is actually from right up to early part of 20 to early part of 2020, so Prime REIT for 2019 did stay above its IPO price of 88 cents. But then, since the plunge in due to the COVID-19 sell-off from 19th of February 2020 to 23rd of March 2020, you notice that Prime REIT has the audacity to fall from more than $1 down to less than, well, close to 50 cents. So you can see the huge volatility underlies the so-called weak or strong institutional support for the stock. Because if the institutional support for a stock or a REIT is so strong, how could it be that within a couple of days, in this case it's about a month, Prime REIT can fall by more than 50%? Okay, of course, if you look at the other REITs like Ascenders, MIT, they do fall, but not to the kind of magnitude. So one of the key things that we share in our classes with our investor students is the behavior of such REITs during such extenuating circumstances, because they tell you the kind of weak institutional investors backing this REIT. And if you know that essentially who are the so-called weak or strong institutional investors backing this REIT, then you would actually do yourself a favor by refraining from and avoiding such REITs. And henceforth, you can see for Prime REIT, since early 2000 up to 2020 up to now, that's 2 years already. Okay, the stock has spent practically all its period of time, okay, in the last 2 years, falling or trading below its IPO price. So briefly, in this last 3 years, 2/3 or approaching 2/3 of the time in which traded in the market, they have spent, the share price have spent 2/3 of their time below its IPO price. That's for Prime REIT. What about the other REITs, ladies and gentlemen? Okay, so, but hang on. I thought, ladies and gentlemen, most analysts in the market is actually touting Manulife REIT, Prime REIT, Capital Old, as well as the US office sector as a turnaround sector. While not surprising, if you look again, you can see that the dividend yield or DPU yield is approaching 10%, one of the highest in the REIT sector, one of the highest in the REIT sector in its 20 years of history. But remember, ladies and gentlemen, you don't get a free lunch. if the DPU is high, could it be hiding certain aspects of disappointment, or are the acquisitions that they have embarked on being able to deliver to you as a shareholder? Same, if you look at the next column, that is the price to book value. Oh my gosh, I thought all REITs, trade close to book value. Why is it that these three REITs actually trade at below its book value? As I've shown you earlier on Prime REIT, as well as I'm going to show you now in Manulife REIT, it is not just now, currently they're trading below book value. They are and have been trading below book value for quite some time. So the basis of which the market is acknowledging or telling you to buy US office REITs because they're trading at book value, does it hold water? Ladies and gentlemen, let's take a look at Manulife REIT. This is the REIT that has the longest history trading in Singapore when they actually IPO'd on 12th of May 2016. So for the first period of its life going into 2017, Manulife REIT actually traded close to its IPO price. In 2017, it did perform for about half a year. Then after that, it came below its IPO price. Then again, in 2019, when the market for all REITs are moving up, not surprisingly, Manulife REIT did perform up. But you can see, ladies and gentlemen, when the COVID-19 sell-off came, the sell-off in the stock was vicious. It fell from a high of 1.07 down to 0.545. That means a loss of almost 50% in a very short period of time. Once again, similar to Prime REIT. So if this REIT essentially is supposedly backed by strong institutional investors, I think the color of the cake was very clear when the sell-off came. Because if there were such good and so-called prime candidates in any REIT's portfolio, they will be the last to be sold off. But if the sell-off essentially are so vicious, much more than other REITs like Ascenders, Capital, Land, Integrated, and LTMIT, then it actually begs this question whether this REITs and how do this REITs rank in institutional portfolio ranking. Because for Manulife REIT, no dissimilar to Prime REIT, after the COVID sell-off for the next 2 years, that's between here from March of 2020 right up to currently 2022. Okay, for the last 2 years, other than a very short period of time where the price came close to above its IPO price, the bulk of the 2 years was below the price. And as you can see, ladies and gentlemen, as I've mentioned in our article, compared to this price and this price, it is still down 40% since its price 3 years ago. So in its 6 years history, ladies and gentlemen, look at this, okay? You will see that other than this brief period, 6 months or so, this is another brief period, maybe 4 months, this is another brief period of another 6 months. And here you can see that the bulk of this performance below its IPO price of 83 cents. During this period, and this period, it's almost 2/3 of its IPO. Yes, it has debuted in Singapore for the last 6 years. Yes, it's one of the REITs giving you an option to invest in US office REITs. But ladies and gentlemen, as an investor, you have to ask yourself, what is the big deal? Especially if you had invested in them since IPO, the share price continued to trade below its IPO price for almost 2/3 of its trading period. So are they value traps or are they emerging to become value traps? You decide. Information, you can see that essentially where the REITs actually qualify as value traps. You notice that we have listed 4 criteria of REITs that are not value traps. So do look in our article clearly. And for those of you who wants to join us for our class, our next upcoming class is actually on 13th of August, where it's a live class. As you can see, ladies and gentlemen, at GCP Global, we champion better investor education and protection for you. Okay, as what we've stated in our last, do sign up quick to enjoy our early bird special at our website, as well as actually like and subscribe our videos, and we'll see you again next week to bring another illuminating as well as reality strikes hard kind of REITs analysis to you. So hopefully you enjoy this video, do subscribe, enjoy our classes. Cheers.